Everybody, thanks for joining us again today. Man, again, we've got a really great episode. I've got my friend and partner, Regina Chen, joining us today. Regina is a dynamite realtor her farm is kind of Irvine, but believe it or not, Regina's got like 4 listings right now that are all over the place. Irvine, some in Los Angeles. So she just really has her finger on the pulse with real estate. One of the things that we wanted to talk about today is, what's going on with the interest rates and with what's going on with the conflict overseas and how that might affect interest rates. So with that said, before we get started, please like, subscribe, and hit that bell. With that said, let's get started. Hey, Regina.
Hey, Barry. How's it going?
I'm doing very well. Thanks for coming again today. It's always nice to see you and nice to have, stimulating conversation. And for those of you that don't know it, before Regina and I get on here, we usually meet and we talk and kind of, have a meeting of the mind. So Regina had said that, some of the things she's running across when talking to clients out there is a little bit of confusion. What's going on geopolitically here. We all know that, there's a lot of trouble going on overseas, and a lot of us are feeling insecure. I can tell you I'm super blessed and feel super blessed to be warm and healthy. And if you're not warm and you're not in Southern California, I do not want you to feel bad, but it is pretty nice here today, right, Regina?
Definitely. We're very blessed, very fortunate, for sure.
So Regina, when you're out there and you're talking to your listing agent, or I'm sorry, your listing clients, and for those of you that don't know that, realtors usually they'll have a client where they list their property. That's ideally almost all. I've never met a realtor yet that doesn't want listings, because you're kind of in the driver's seat, right?
True.
Especially in this market. And then you've got buyer agents who represent the buyer, and most realtors do both of those things. And that describes you, Regina, right?
Yes, that's correct. And Barry, I think today is like a perfect time. Actually, you are the expert when it comes to like mortgage rate and interaction with all the government's activity and measure. So like you mentioned, like right now, I think the latest, everybody's watching the news, reading the headline, wondering how the geopolitical situation gonna impact on the mortgage rate, housing market overall. I've been talking to my seller and buyer. People at first hear about the activity going on. Their initial response that, oh my God, that's gonna make the mortgage rate even higher. And then to everybody's surprise, what? We actually see a dip. What's going on? Well, you definitely is my teacher, consultant I always go to when it comes to like mortgage rate. So let's talk about it a little bit. So break it down so people can better understand how interest rate works. What are the factors going to be driving up or down of a mortgage rate?
Awesome. Yeah. So the first thing I think where we should start is prior to what's going on, overseas with this conflict. And we talk about what we need to talk about is the fact how interest rates go up. Why do they go up? Why do they come down? Right? Like, people I find often think that it's arbitrary. Like, hey, times are good, and banks want to make more money, so they raise their interest rates. It doesn't work like that. And a lot of people think that it has to do with the Federal Reserve raising rates. Now, it kind of does have something to do with that, but not directly. And let me explain. So, for instance, a lot of people think that the Federal Reserve has already raised interest rates, because you hear it all over the news. I mean, my God, you can't go anywhere without, on any one of the, I don't care, if it's not even a news channel, it seems like, if you're trying to watch something and some flash comes on and it talks about, something scary so you got to remember, they're trying to get you scared when you're watching the news, and even when you're on YouTube, you see pictures of people going, like
Yeah.
market crash coming in
Oh,
2022. It's crazy, right? So I'm going to share my screen real quick with you guys and show you something, because I think you're going to find this interesting. I may have even talked about this in the meeting that I had previously with Regina, or the video that we did. But this is a 30-year bond chart, you guys, and this is how interest rates go up and down, is what's happening in the bond market. So if I were to zoom into this, you would see that these are called candlesticks. Each one of these candlesticks represents a day. When you see bonds going down, that means bonds are going down and rates are going up. So the bonds are being bought by people that are in charge of billions of dollars. We're talking about hedge fund managers and really well-to-do investors. Well, if you take a look here, you'll see that bonds started tanking like last October. Bonds started tanking because the Federal Reserve stopped talking about inflation being transitory. They said, we're going to remove that from our vocabulary, meaning that inflation was only going to be here for a short period of time. So when they said that, bond traders went, uh-oh, the Fed is going to start raising interest rates. So bond traders, they're thinking in 6 to 8 months ahead of whatever is going on in the economy. Even though the Federal Reserve did not raise interest rates, all of our interest rates went from like 3% up to 4% within a period of 6 months. From October until now, the difference there is about a full percentage point in interest rates on the anticipation that the Federal Reserve was going to raise rates. Now, this also has to do with bonds, that the enemy of bonds are inflation, right? So if all of a sudden these bond traders start seeing that that inflation is going to start coming into control, it's going to start coming down, then you'll start seeing them buy bonds and rates will come down. So this is a really unusual situation in time where we could see the Federal Reserve actually raising interest rates, but bond traders will start buying bonds and rates will come down because of the way that the Federal Reserve is reacting to the inflation. If they're being incredibly aggressive, we call that hawkish. That sends a sign to bond traders, the Fed's serious about bringing down inflation. Maybe we should be buying bonds again, and that causes rates to go down. Now, what causes inflation? Well, it's not, Regina and I think when we first started talking about, the bad word recession, Regina got a little nervous. She's like, whoa, hold on a second. Recession, like, I don't know. That's a bad word. I don't want people to get scared, and it's because people think about recession to what happened back in 2008. That was actually caused by the mortgage industry. That was caused because we had, millions of loans out there from people who were lying about their income. They weren't coming in with any down payment. So when that domino started knocking down the rest of the dominoes, all these people walked away. They didn't have any skin in the game. And that was caused by the recession. But traditionally, what a recession means is that people just stop spending money. They start saving. They're not buying that extra car. They're saving. And so that pullback in the economy means the economy is contracting. Now, the way that the Federal Reserve reacts to that is they go in and they lower interest rates. Now, we're not seeing that happen because inflation is going up right now. That's why they are raising interest rates to try and cool the economy down. No matter what anybody tells you, if your Aunt Sally and your Uncle Jack and your coworker is telling you that, they think that, we're in terrible times right now, I got news for you. The economy is rocking. That's why inflation is as high as it is right now. But it's also a combination of the fact that there's this supply chain. We're stuck still. You
Challenges.
remember,
Yeah.
yeah, Regina, you remember when they were like, pictures of ships miles long waiting to go into San Pedro Harbor, right?
Yeah. Yeah.
Everything was going up. I mean, you
Yeah.
go, and it still is going up. You go buy some furniture, you might have to wait 2 months instead of 2 weeks. And now you combine that now with what's going on with the conflict, and now it's going to get more expensive to deliver goods because, of the oil issue that we have with, cutting off Russia. They're trying to circle the rest of the countries together so we
Right.
don't really skip too much of a beat. So we're seeing the interim. We're seeing that everyone knows this is going to cause higher inflation. And it's almost like the bond traders are not even counting it right now. They just kind of go, we know that this isn't because of something that is happening here in the US. This is something happening that is out of our control. So this is why we're not seeing rates skyrocket even further. I mean, usually, in really uncertain times like this, when oil, let's face it, everything we buy is, it's something being delivered, right? Like whether it's a car, whether it's furniture, whether it's food, it's all affected by oil. Normally, when oil skyrockets like this, man, interest rates just go to the moon. But bond traders are kind of going, yeah, we think that this could be a temporary problem. So I don't want to go into too many granular details with you guys. I think I probably talked enough already as it is. But what I want you to understand is that as inflation starts to come down, as the Federal Reserve raises interest rates, your interest rates have already been raised. As the Federal Reserve raises their federal fund rate, what they're doing is they're trying to prevent us from going off a cliff in recession with inflation, and they're trying to bring down inflation. If they start to bring down inflation, you're going to see all of us are going to see our rates theoretically could start coming down because bond traders will start buying bonds. So now, with that said, a message I know Regina always sends that I want to try and get through to you guys is that, and we're going to do another video all about like, how is this affecting the housing market? But what I want you to understand is that values are going up. They went up over 20% last year in Southern California as a general rule of thumb.
That's right. Yes.
Values are still going up. So what are you going to do? You going to wait till interest rates come down to start, thinking about buying while values are still going up? Smart thing to do. Regina and I were talking earlier, and we feel like some people might be getting priced out of the market because, if you could afford $1 million house, 6 months ago, and now interest rates are up and the values have gone up, you might only be able to afford an $800,000 house. Some people will leave the market, but some people who, have the wherewithal to be able to buy, they're still out there. So, what do you see happening with inventory right now, Regina, and how?
Yeah, I feel like, it's inventory will still continue to fluctuate. At what time, by how much, it's hard for anybody to predict. So I always advise for my seller, buyers now, stay the course. If anything, this is a time you probably need to be more proactive. It's a good thing, right? Right now we see a dip right now, but the thing is focus on, don't give up. Keep going, power through. Like Barry mentioned, we know that this year, at least in Irvine, we're projected to see probably another 10% appreciation home price wise. So there's no point to wait, and we cannot predict. Don't try to find the lowest point to lock in the mortgage, because today's market, there's nobody can predict that, can't do that. What we need to do is continue to write out offer, be proactive to see the home, and make sure that's the home you like and you can afford the monthly payment. That's the only thing we can control, we can focus on. Whatever the mortgage rate is, there's always time, because like we talk about, it's going to fluctuate. You always have the option to refinance it if when with mortgage come down lower than what by the time you are going to escrow or close the deal. So that'll be my advice for all the buyers out there.
That's right. Well, Regina and I were talking before we went on air, and we were I was sharing with her a client of mine that just went into contract, and this client is reaching for the moon. They know they want to be here for at least 10 years. Their family is growing. They have young children that are growing up that are going to need their own bedroom. They want to live in Irvine because that's where the great schools are, right? Like, I mean, man, you talk to anybody that lives in Irvine, and I guarantee you 7 out of 10 of them will, if you ask them, why did you move to Irvine? They go, it's schools, right? So like, if you've got kids and you want your kids to get an incredible education, you usually wind up picking Irvine. So if you want to stay in Irvine, you got to say to yourself, what do I think the value of homes are going to be 10 years from now? Not what do I think they're going to be a year from now or even 2 years from now. What are they going to be like 10 years from now? Because folks, I got news for you. They're not making any more real estate. And they might have a few homes here and there that are popping up, but my clients are stretching it. They're going above and beyond their comfortability for their monthly payment, because I explained to them, I go, look, interest rates go like this. We're going to be able, chances are, I'm not right 100%. I'll put that disclaimer out there, but I am right most of the time, not because I'm so brilliant. It's because I'm a student of this. I listen to economists and market movers, and I'm not watching the traditional CNBC nonsense that's on there. I'm listening to people that actually really do know what they're talking about. And what I see happening is that at some point, recession, we're going to see, you're already hearing about it, talks of recession. The Fed is going to do what they have to do to fight that. Interest rates are going to come down. And I showed this client, if interest rates go back down to where they just were 6 months ago, this client's going to save about $800 a month. So they're like, okay, well, great. Let's swing for the fences, Barry. We trust you. And we, at some point, we know we're going to be able to lower our monthly payment. We're willing to bite the bullet for 12 months, or 18 months, whatever it is, when we get that lower interest rate for them, because they feel, I hate to use the word no, because California could fall into the ocean. We have no idea whether we're all going to be here tomorrow, but pretty good idea that real estate in Irvine is going to be much more expensive a year from now, or especially 10 years from now. Don't you think, Regina?
For sure. Totally agree.
So the message here is, what I would encourage all of you guys is to tune out the noise, tune out what's going on the news, tune out what, when I got into this business, interest rates were like 7%. I remember throwing a party when they went down to 6%. And, so traditionally, historically, we are still at ridiculously low interest rates. Are they going to go lower? I don't know 100%, but, if past performance means anything, there's usually going to be an opportunity at some point. But you may not, if you don't have a home, or if the home costs you more, what difference does it make if interest rates come down? If you wait until that home that you want to buy for 1.3 million is now 1.5 million, who cares if you save a point?
Yeah.
Doesn't matter, because you just paid $200,000 more than if you would have called Regina today and asked her to help you buy a house, right, Regina?
Yeah. So like we talk about, it's most important, get the home, and the rate drops. It's easy to pull the trigger to refi, but not the other way around.
That's right. So tune out the noise, figure out what you need for your family, get a hold of Regina, let Regina do that initial consultation with you. She's going to go over and show you where the inventory's at. She's going to show you, whether or not she believes we're going to see, maybe a little spike in inventory because she's following the trends. I mean, guys, I have a couple of hundred realtors that, I know and that I talk to often. Regina is one of the most plugged in people I know. She is constantly reading and listening to different experts, so she has an informed opinion. So meet with Regina. I don't care if you use my team or not as a lender. If you want to meet with me to kind of go over your individual situation and you still want to use whoever it is you want to use, then God bless you. I would love to try and help you and at least help you to make a solid decision. I think by the time you're finished with my team, you'll understand what our value proposition is. And that's why I'm willing to give my time so freely to all of you. So, man, your time is valuable. Regina, thank you so much for giving me this format. I know I did most of the talking today, and I appreciate
No, that's
you
the
doing
whole
that.
point. You're the expert in this area. I appreciate your sharing.
Awesome. Well, guys, like I said again before, please, if you get a chance, like, subscribe, hit that bell. And I hope everybody stays happy, healthy, and safe. Don't hesitate to reach out to us. Take care.